going to be economics, chapter 2, size of economics A level, chapter 2, size of businesses. When we talk about size of businesses, we're talking about how big or small a business is. So I wrote, this applies to how big or small businesses are compared to one another. So when you talk about the size of a business, we're simply comparing one business to another in terms of how big or small they are. So we have the large firms. There are large firms and there are many industries where small and medium-sized enterprises are important. So based on the fact that we're talking about the size of a business, we simply have businesses that are so large and we have small and medium-sized businesses, SMEs. So, but most of the time, most in every in every economy, we have the larger proportion of SMEs than large businesses. So SMEs are independent firms, not owned by another firm. They employ fewer than 250 employees and may have an annual turnover of not more than 50 million euros and an annual statement of not higher than 43 million euros. So we call them SMEs because they have fewer number of employees. So the largest number of employees they could have is around 250,000. Yes.
What is the difference between an annual turnover of not more than 50 million and an annual statement of
Financial position. Yeah. A turnover is talking about like the profit. Then the statement of financial position talks about the assets and the liability of the company. So the value of the assets, the value of the capital base, that is in the statement of financial position. So for your statement of financial position, we're talking about your assets, which must be equals to capital plus liability. So the value of your financial statement, which is of your balance sheet, must be around 43 million, but your turnover should be around 50. So profit, the turnover goes with the profit. That's the statement of profit or loss account. Then when it comes to financial statement of financial position, we're talking about asset, liabilities, and capital of the business. The resources that the business owns, the resources that the business owed to third parties, and the amount of money invested by the owners of the business. So that is what the 43 million is about. Is it clear?
Yes.
Great. So for a large corporation is the one that has more than 250 employees and an annual turnover more than 50 million and a statement of financial position of 43 million or higher. So the opposite of an SME should be a large business or a large corporation.
Okay.
They have high number of employees. They have more than 500 employees. They have high numbers of turnover, more than 250 million turnover, and they have more than 43 million in terms of the work of the business. I think the point is clear there. Great. So that takes us to large firms. Why do they exist? So they said large firms exist for two main reasons. One, for economies of scale and barriers to entry. So when we talk about economies of scale, so we have a lot of businesses wants to become large so that they can exploit economies of scale. And when we talk about economies of scale, we're talking about a cost reduction due to expansion because the business has expanded. So it's able to reduce its cost of production. So one of the reasons why businesses wants to become large or big is because they want to exploit economies of scale. That's the first one. The second one is barriers to entry. Now, as soon as the business becomes bigger, it might be able to ward off potential competitors. Because how big you become might be scary for new businesses to come and set up. Look at Coca-Cola, Pepsi. There should be more colas, but they don't have that financial strength to compete with Coca-Cola. So there's no. Do you understand? So when the business becomes bigger, it becomes a threat to potential competitors. So those are the two reasons why a business might choose to become bigger. I think the point is clear.
Yes.
Good. So for a small business, a small firm survive for the following reasons. So for small businesses today, they are able to survive. What are the reasons why a small business might be able to survive? Number one, economies of scale. It may be very small in relative to the market size that brings about these economies of scale, which may allow small firms the cost advantage, especially in a small niche market. So one of the reasons why a small business might be able to survive in an industry is because of economies of scale. So if the economies of scale in that industry is not so big, it simply means it allows a small business to compete with the bigger businesses. This is how it works. If a large business in an industry is unable to exploit economies of scale, it simply means it won't be able to sell at a higher price compared to other with the smaller businesses. So that means they're going to sell at the same price. So selling at the same price allows the small businesses to survive. Get the point here? If the economies of scale in an industry, it's not that much. It means both small businesses and large businesses will be able to survive, especially the small businesses, because they will be able to sell at the same price as the large business, and that might allow them to stay in the market. Do you get the first point there? The second one, the cost of production. It may be higher. It may be higher for a large-scale producer than for a small firm. This may be due to productive inefficiency. For example, a large firm may be poorly organized compared to a small business. A large business may be forced to pay higher wages to their employees, while a small business may be able to pay a relatively low price. So another reason why a small business might be able to survive is the cost of production. For large firms, they might incur more costs than a smaller firm because they might be forced to pay large amount of wages. They might have to pay huge amount of money to their employees, while a small business might not be able to pay that. You know, it's a small business. You wouldn't even want to ask for more. But for large businesses, employees might ask for more. That's one of the reasons why large businesses might have an increased cost of production compared to a small business. Another reason is this. A small business might be able to survive in an industry because large businesses might be poorly managed. That brings about these economies of scale. The business become too big that it's become unmanageable. So they are unable to manage them, and that brings about inefficiency. So the inefficiency of the large business might become an advantage for the small business, and the small business might be able to survive. Do you get the first point? The
Yes.
second point here. No, we're talking about how a small business might be able to survive in an industry. The first one is economies of scale. And when we talk about economies of scale, we're talking about the cost advantage. So if the cost advantage in that industry is less, it simply means a large business in that industry will not be able to exploit economies of scale. So that definitely they will be able to sell, they will be selling at the same price as a small business. So selling at the same price as a small business means that they are not going to be able to compete with a large, they are not going to be able to, the small business will be able to stay and survive in that market because the prices are the same. Large businesses will not be able to sell at a lower price. Then, so it simply means they will be selling maybe at a competitive price. And selling at a competitive price might give a small business an advantage. How? Small businesses have the flexibility to offer personalized services. So customers might choose to go to a small business than a large business, even as much as they are selling at the same price. Most of the time, small businesses they know their customers, unlike a large business. Compare a urban supermarket or Mama's supermarket to a supermarket in your estate here. So in your estate, the owner of that supermarket knows you. He can literally call the names of all customers, but go to Mama's, they don't know you. So you might have emotional attachment with the supermarket around you than a big one.
Okay.
So that makes a small business to survive. The second one is about the cost of production. Large firms tend to pay more to their workers, while a small business might be able to find a way around paying less. So that gives them a reduced cost of production, and that increases the cost of production for large businesses. Large businesses might be able to might be paying higher taxes, which small businesses might even have a tax holiday. Do you understand?
Yeah.
So that increases the cost of production for larger firms, and that might be an opportunity for a small firm to excel. The third reason why a small business might survive in an industry is that barriers to entry may be low. So if the barrier to entry are those reasons why it becomes difficult for a small business to go into the market. So if the barriers to entry are low, it might be because the products that they are producing in that industry is simple to produce, or there's flexibility in the market. So this allows smaller firms to gain authority, and they'll be able to survive it. Do you understand?
Yes.
Barriers to entry are simply what makes it difficult for you to penetrate into that market. One of the reasons is that there might be technicality in the product, or if there's technicality in the product, it means you need financial strength to be able to buy equipment needed. But if there are simple products produced in that market, then it allows you to enter the market, then you can survive. Do you understand the point there, please? So these are the reasons why. Okay, and the last one, a small firm can be a monopolist. Another reason why a small firm might be able to survive in the market is that the small firm might be a monopolist. And when we talk about a monopolist, we're talking about a business that produces the only product needed in that market. So one of the reasons why a small business might be the monopolist is that the demand in that market is not that too much that the small business cannot take care of. It is not the market, the total demand in that market is not large for the small business to take care of it. So if the demand is little, then a large business will not even want to do that. So that allows a small business to be a monopolist. So these are the reasons why a small business might be able to survive. The reasons are: one, economies of scale, high cost of production for large firms. Um, Small firms they might be monopolists, and what else we talked about? And barriers to entry might be low. So these are the reasons why a small firm might be able to survive in an industry that comprises or contains large firms. Any question about that? Thank you. So we move on. Now we go to how businesses grow. Are you there?
Yes.
So how businesses grow? So firm grows in size through the following ways. They can grow organically or through external growth. When you talk about organic growth, it simply means growing within using your own resources to grow. And when it comes to external, it means there's integration. So we're going to start with organic growth. Here I wrote. Organic growth, this implies to an internal growth which occurs as a firm increase their output through investment or increasing the numbers of workers they have. So when you grow as a firm using your own resources for your growth or for your expansion, we call it organic growth. I think it's clear.
Yes.
Then we have the external growth, which is the same as integration. Integration occurs when two or more firms come together through merger or acquisition or takeover. Do you get it?
Yes.
That place. So for merger, what does merger simply mean? It simply means the joining of two or more firms under the same ownership. That is what merger is about. I think you get that.
Yeah.
Then we have takeover. For takeover, it means a firm is buying over another firm. So firm A is buying over firm B to become firm A. That is takeover. Firm A is merging with firm B to become firm A and B. That is merger. I think you get the difference here. Great. So during takeover, the board of directors are meant to be in charge of considering the bid and recommend it to shareholders if to accept or not. So if firm A wants to buy over firm B, the board of directors of firm B would receive the bid and check if it is ideal for them to sell. Then if it is ideal for them to sell, then they announce it to the shareholders. I think the point is clear.
Yes.
So what are the types of integration we have? We have horizontal integration, vertical integration, and conglomerate integration. Those are the three types of integration we have: horizontal, vertical, and conglomerate. Are you with me?
Yes.
So I'm going to start with horizontal. Here they start with vertical, but I'm going to start with horizontal, okay?
Okay.
Yeah. So go to horizontal here. Go below it. You see it? Horizontal. Can you find it? Okay. So for horizontal, this is a form of integration which occurs when two or more firms in the same industry and at the same stage of production come together. We call it horizontal integration because firms in the same industry at the same stage of production are coming together, either through acquisition or merger. So school A buying over school B, that is horizontal integration. Do you get it?
Mhm.
Or pharmaceutical A buying pharmaceutical B, that is still horizontal integration.
Okay.
Is horizontal integration clear? Good.
Yes.
So what are the advantages of horizontal integration? One, the first one, it will bring about economies of scale as integration may lead to reduction in average cost of production. The first advantage about integration is that when you integrate, it simply means you are expanding your business, and expansion will bring about reduction in the cost of production. That is what economies of scale is. You get the first advantage?
Yes.
The second one, it reduces competition in the market as competitors are removed from the industry. if in the market or in the industry we have 7 firms, we have 7 firms in that industry. So part of the seven firms, 2 firms have already merged together. So it remains how many? It remains 6 firms. So that reduces competition. Yes or no?
Yes.
So if competitors are reducing, it allows the firms to make more in terms of market share. Do you understand the second
Yes.
advantage? The third one, firms will be able to control prices in the market. So now that the competition is reduced, it allows firms to have more authority in the market. So they might become price maker instead of price taker. Do you understand?
Yes.
And so the last one here, it allows a firm to buy unique assets of another firm. So I might be buying your business because you have some uniqueness in it that I don't have. So if I'm able to buy your business, that means I am able to buy. If I'm able to buy your business, it means I bought the uniqueness in your business, and that could become my own unique selling point.
Mm.
Do you get it?
Yeah.
Any question about that?
No.
And the last one, the last advantage here is that it allows the business to grow in markets where it has knowledge and expertise. So this is likely to bring about a successful merger. So the point here is that with integration,
Yeah.
it means if a school is integrating with another school, it is in a school, it's an industry. So they know more about it, and that could lead to success in that merger. Do you get it?
Yes.
But what is the problem about horizontal integration? Most horizontal integration are not always successful due to being poorly managed and buying from and buyers and the buyers and the buyers and the buying firm paying too much for the firm they are buying. So most of the time, nobody wants to sell at a loss. So if you say yes to the price I'm offering you, it simply means I am offering you more than what you're expecting. So it means I might be paying too much for what I'm buying. That means it is overpriced. Do you understand? So that's a disadvantage for the buying firm. Do you understand? So that's about horizontal integration. Any question about horizontal integration?
No, sir.
Good. So we'll go to vertical now. Are you there?
Yes, sir.
So for vertical integration, okay. So this is a form of integration which occurs between two or more firms at different production stage in the same industry. They are in the same industry, but at different stage of production. So it might be, when we talk about different stage of production, it might be closer to the, it might be retail, it might be retail, it might be extraction, it might be conversion. So this is what we mean by different stage of production. Production involves extraction, conversion, and selling. Yes or no? So these stages are different stages. So when it comes to vertical integration, is either you are closer to the resources or you are closer, to the resources, which is backward, or you are closer to the consumers, which is forward. Do you get vertical integration here?
Yeah.
We call it vertical because it's either it is closer to the supply or closer to the consumer.
Okay.
So if it is closer to consumer, we call it forward vertical. If it is closer to the resources, we call it backward vertical. I think the point is clear there.
Yes.
So for forward vertical, I explained already, right?
Yes.
The integration goes further down the supply chain. It is forward because it goes down further to the supply chain. And it is backward because it's in charge of the supply chain. Do you understand?
Yes, sir.
Any question about that?
No, sir.
So what are the advantages of vertical integration? Number one, it brings about efficiency, as integrating a supplier or buyer may be cost saving if there's a firm. Okay, for example, Coca-Cola. There's Coca-Cola bottling company. The bottling company, if Coca-Cola only gets the liquid, has the liquid, and there's a bottling company that supplies the bottles needed. Now, Coca-Cola is buying the bottle needed. That is supply. So that is backward vertical. Yes or no?
Yeah.
So if it simply means Coca-Cola has the opportunity to reduce its cost because it's now the owner of the supply. So that brings about efficiency. Do you understand or not?
Yes, sir.
The second one, it reduces the risk as integrating firms handle the supply chain, which may in turn give them a competitive advantage over competitors. It reduces the risk. How? It reduces the risk because now the supply chain belongs to you. So you're not going to wait for your suppliers anymore because you become the supplier. And that would give you an edge over your competitors. Do you get it or not?
Yes, sir.
The third one, it allows the business to go in market. No. Okay, take this. Yeah, the third one, forward vertical give a firm more control over its market. So with forward vertical, you have control of the customers, yes or no?
Yes.
So that means you can as well decide what happens in the market. Before now, you don't have control over over the customers. You only supply to you only supply to your buyers. Now you have bought the buyers. So the buyers, that means, yeah, you bought the buyers from you. So those that buy from you sells to the customers, yes or no?
Yes.
But now you've bought your buyers. So it simply means you can now directly sell to the customers. So that gives you access to control over the market. Do you get it?
Yes.
A firm making vertical manager may lack expert. Now, the problem is that a firm making vertical manager may lack expertise in the particular industry, which may lead to poor decision making and failure. The problem is that now that you are buying, now that you have access to the customers, you might not have expertise in how customers' minds are because you don't deal with customers before now. So that might bring about poor decision and might bring about a failure. Is it making sense?
Yes.
Great. Another problem is that firms often pay too much for the firm they take over and share prices fall rather than rises. Like I said earlier in horizontal integration, if you're a buying firm might pay too much to the selling firm. And that might not be ideal because you are wasting money. Do you understand?
Yes.
And the last one here, second to the last one, there can be difficulties. There can be difficulties in merging two firms together into one firm. This could be based on the cost of creating a single firm, or two firms fail to integrate and costs continue to rise. You have two firms that are coming together. These two firms have they have different culture. They have different employees. Now you want to put them together, it might be difficult. So there might be difficulty in integrating, or it might even take time to integrate them. So if it takes time, it takes money. That increases the cost. And that might be a business running at a loss. Do you understand?
Yes.
And the last one, many of the workers of the firm that has been taken over may leave, taking with them much of the expertise that makes the business to succeed. So another problem about vertical integration is that after vertical integration is done, some of the workers, if it is forward vertical, some of the workers might choose to leave. So if they leave, they might be leaving with the experience, the expertise that makes you to buy the company. And that means the business will run at a loss. Do you understand?
Yeah.
Any question about
No.
vertical integration? Good. Then the last one is conglomerate. So for conglomerate integration, I wrote, this is a form of integration which occurs between firms with no common interest, like a school buying over a hospital. So there's no common interest there. It's a school, it's an educational industry. Hospital is the health industry. So they don't have common interest, but owners might wish to buy. Do you understand? So here, what are the advantages of going into conglomerates? Number one, it allows owners to spread their risk. That's the first advantage. Now that you are buying different business from different industries, it means if this industry is going down, the other industry might be going up. So you are able to spread your risk. It reduces your risk. That is the point there. I think it's clear. Is it clear, please?
So, for example, if there's a pandemic, instead of kids going to school, they can have it. They can go to healthcare.
Yeah, they could go to, yeah, much of health resources will be needed. Do you understand? So that's what conglomerate is about. Two, it allows flexibility for expansion as successful senior managers can be transferred from company to company. If in company A, there are managers there that are successful, you can transfer them to company B that is lacking that managerial skill. Do you understand?
Yes.
So there's flexibility when you want to expand. The third one, it is an opportunity for what we call asset stripping. When we talk about asset stripping, it simply means you figure out that certain company has valuable assets. Then you are buying that company so that you'll be able to make profit out of the assets. That's what we call asset stripping. Some companies, what they do is they buy assets of companies. So in the course of to buy the asset of a company, you might have to buy the company as a whole. Then you start selling the assets differently. Do you understand?
Yes.
So, but you can only do this if there is conglomerate. Do you understand?
Yes.
So that's another advantage about conglomerate. However, the problem about conglomerate is that firms don't have expertise in the market. A school industry buying a health center, The owners of the school might not have idea about
the business.
the health sector. So that means they lack expertise, and that might reduce or that might worsen the performance of the business. So if that happens, workers might even lose their jobs. Customers might start thinking otherwise, like, oh, these things they used to buy, they are unable to buy them anymore. So the business might start losing value, and that might bring about failure. Any question about that? So that ends integration. So in the next class, we're going to talk about how businesses, the constraint on business growth. Is it clear?
Yes.
Okay.